Boeing hired a new CEO to, quote, restore trust, probably flown on an airplane made by the Boeing company.
Boeing's iconic factories once symbolized American industrial might, but today they tell a different story, one of plummeting stock prices and abandoned assembly lines. How did Trump's tariff send this aviation giant into a tailspin? The dominoes fell fast. Ryanair walking away from billion-dollar deals, Airbus swooping in to claim Boeing's crown, and Washington scrambling to contain the damage.
What is it you get paid to do exactly?
I get paid to run the Boeing company.
Yeah.
This unfolding disaster reaches far beyond one company's boardroom. It's a red alert for America's economic future. Strap in as we trace the shocking events that turned a national treasure into a cautionary tale. The tariff bomb that broke Boeing. Boeing was operating at peak efficiency before the tariffs hit, relying on specialized suppliers like a German avionics firm and Japanese carbon fiber manufacturers. This global network kept costs predictable and quality high until the Trump administration imposed a 25% tariff on aircraft components. Overnight, Boeing's supply chain unraveled. Take that German avionics supplier. Their $10,000 navigation modules suddenly carried a $2,500 tariff. Multiply that across thousands of components, and a single 787 Dreamliner's production cost spiked by millions. Boeing couldn't absorb those hits. Profit margins collapsed, triggering a 20% stock plunge in 3 weeks. Investors saw this wasn't a blip, but a structural crisis. The irony? Tariffs meant to protect jobs now threaten 140,000 Boeing positions. When the German supplier halted shipments, production lines stalled. Labor unions that backed protectionism now beg for intervention. Even worse, airlines balked at higher prices. Ryanair canceled orders outright, blaming tariffs for making Boeing jets uncompetitive. Other carriers followed, leaving Airbus to scoop up deals. Here's the domino effect. A single tariff disrupts a German supplier, which delays Boeing's deliveries, which forces airlines to cancel, which tanks stock prices. The $2,500 surcharge on one part seems small, until it topples contracts worth billions. Competitors pounce while Boeing scrambles to renegotiate terms, but forcing airlines to cover tariff costs isn't sustainable. Buyers walk away. The real damage? Trust. Decades of global partnerships shattered overnight. Once suppliers and customers eye alternatives, like Airbus' tariff-free supply chain, rebuilding becomes nearly impossible. What began as protection became a liability, with fallout rippling from factory floors to Wall Street. And this is just the beginning. Ryanair's warning shot. Ryanair's cancellation of 3 Boeing deliveries on May 7th sent shockwaves through the industry. The European low-cost carrier, operating an all-Boeing fleet of hundreds of 737s, had been one of the manufacturer's most reliable customers until US tariffs made the jets unaffordable. A leaked letter revealed Ryanair couldn't absorb the sudden cost increases. "These tariffs have destroyed our deal," CEO Michael O'Leary declared publicly. This wasn't corporate posturing. Their budget model couldn't sustain millions in added costs per aircraft. When Europe's largest discount airline walks away, the market listens. Like dominoes falling, Turkish Airlines immediately demanded price renegotiations. Latin American carriers delayed payments, while African airlines paused new talks entirely. Over 200 orders now hang in limbo as airlines reject tariff-driven premiums. Boeing's contracts technically require customers to cover these costs, but that legal fine print backfires when prices become unsustainable. The company faces an impossible choice: swallow the costs and crush profits, or pass them along and lose orders. The damage runs deeper than cancellations. Airlines plan fleets years ahead, and tariff uncertainty makes Boeing a risky bet. Why commit when US policy could arbitrarily hike costs again? Airbus, unaffected by these tariffs, gains ground with every hesitation. Ryanair alone represented $6 billion in potential revenue for 210 planned 737 MAX jets through 2028, now likely gone forever. Boeing's stock plunged 8% in the week following Ryanair's move. Investors recognize these cancellations as symptoms of deeper trouble. The narrow-body jet market isn't infinite. Airbus already operates at full A320 production capacity, meaning lost Boeing sales often vanish permanently. Supply chains reel from the chaos. Boeing's production relies on predictable orders to schedule parts and labor. Mass cancellations forced costly slowdowns and inventory write-downs, threatening jobs in Renton and Charleston. The very tariffs meant to protect American workers now jeopardize their livelihoods. Ryanair's decision exposed Boeing's new reality. U.S. trade policy has made its pricing unpredictable. Trust built over decades crumbles in months. Even if tariffs vanish tomorrow, the damage might be irreversible. Suppliers in revolt. Boeing's global supply chain faced catastrophic disruption when tariffs made imported parts prohibitively expensive. A Japanese electronics supplier terminated its decade-long partnership after the 25% tariff erased profitability. Similar decisions cascaded through Boeing's network. A German avionics firm halted flight control system production, while Canadian machine shops stopped shipping precision components. These weren't isolated incidents, but systemic failures that left Boeing scrambling for alternatives within weeks. The human toll emerged quickly. In Missouri, a metal fabricator cut 2 production shifts, eliminating 70 jobs. Arizona's 30-year-old cabin interior supplier shuttered completely. Spirit Aerosystems in Texas laid off 100 workers as orders vanished. These weren't temporary setbacks, but permanent losses for skilled workers and communities where aerospace manufacturing anchored local economies. Airbus seized the advantage. European suppliers facing untenable U.S. tariffs simply redirected production to Airbus facilities in France and Germany. The math was brutal. Absorb punishing costs for Boeing or transition to Airbus's tariff-free supply chain. Many chose the latter, accelerating Boeing's erosion. The tariffs backfired spectacularly. China's aerospace sector grew unaffected, while European suppliers adapted by serving Airbus. The real damage struck American workers and manufacturers tied to Boeing's operations. Even surviving suppliers faced impossible choices: eat the tariff costs or price themselves out of contracts. Boeing's vulnerability compounded existing crises. Still recovering from the 737 MAX fallout, the company lacked resilience when the trade war hit. Rebuilding supplier relationships would take years, if possible at all. What was pitched as economic protection became self-sabotage, weakening America's industrial base while handing Airbus a strategic windfall. The architects promised strengthened manufacturing. The results delivered broken networks, vanished jobs, and a crippled competitor. Airbus and Comac move in. Boeing's struggles have created openings its competitors are exploiting with remarkable speed. Airbus just secured preliminary agreements to sell 500 jets to Chinese carriers, what could become the largest aircraft deal in Chinese history. This order fills Airbus production lines for years, effectively locking Boeing out of its former key growth market. Chinese airlines can't risk relying on Boeing when US tariffs make deliveries unpredictable, and Beijing has clearly signaled its preference by directing state-owned carriers toward Airbus. Meanwhile, China's Comac is accelerating faster than expected. The manufacturer increased C919 production targets by 40% this quarter, aiming for 150 jets annually by 2028. While the C919 currently uses Western components, Comac plans to replace them with domestic alternatives within 5 years. The tariffs have backfired. Instead of pressuring China, they've sped up its aviation independence. Every C919 delivery means one less Boeing 737 in China's skies. The numbers show how quickly the market is shifting. Airbus reported a 30% quarterly order increase, while Boeing's dropped 40%, giving Airbus 60% of the narrow-body segment Boeing once dominated. It's like a relay race where Boeing dropped the baton. Airbus is sprinting ahead at full capacity while Boeing idles production lines. This isn't temporary, it's a fundamental realignment that could take decades to reverse. Geopolitics magnifies these shifts. European leaders see this as their chance to break American aerospace dominance, while China fast-tracks Comac's global ambitions. Both recognize Boeing's weakness creates opportunities they wouldn't have otherwise. The tariffs meant to pressure competitors instead handed them advantages. Airbus benefits from Boeing's supply chain issues, while Comac develops without full competition. The damage may already be irreversible. Even if tariffs disappeared tomorrow, Boeing would need years to rebuild trust. Airbus is securing long-term contracts, and Comac is developing next-generation aircraft. Every month widens the gap. The real question isn't why this happened, it's why Washington hasn't fixed it. Stock prices fall, orders cancel, competitors grow, yet the tariffs remain, crippling one of America's most important exporters. What began as a trade dispute has become an existential crisis for American aviation. Conclusion: Boeing's crisis isn't slowing down. The tariffs remain, losses pile up, and competitors like Airbus and Comac are seizing control. Every day without a resolution costs Boeing $50 million, nearly $2 million an hour. Airlines aren't waiting, they're shifting orders elsewhere. Suppliers have moved on, signing deals with Airbus. The US government won't budge despite warnings. A Senate bill to exempt aircraft parts failed by just 3 votes, a policy failure with staggering consequences. This economic self-destruction is preventable, yet nothing changes. How much longer can America afford this? Share if you believe it's time to save Boeing and the jobs it supports.